Hi, my name's Adam. Welcome to the channel. Thank you for joining us today. Before we jump into the content, which is a really good one, we're going to talk about the impending recession. Is there a recession coming? What does that look like? And how do you best prepare for it? I want to say thank you to all of you that entered for the free financial plan. We did do the giveaway. We put a post on the channel. A lot of you didn't see it, so I wanted to announce it here today. Carl and John are the two winners. They received a $100 Amazon gift card each. And the people that they nominated, which were Daryl and John, have been in contact with them, and we're getting their financial plan started for them and their spouses. So looking forward to doing that. Again, thank you to everyone that enrolled in that. There were close to 700 of you. So that's unbelievable. And for any of you that put an entry in, the last question I had in that entry is, what kind of topics do you want us to cover in 2023? And that is a list that I'm going through. So I have a lot of topic ideas. I've kind of taken everything that you guys have asked for, and we're going to be rolling that out in 2023. This channel is for you, the viewers, and so we want to make sure that we're putting out content that you all want to see. So we'll be doing that in 2023. Wouldn't it be nice if you didn't have to worry about market recessions? Well, most of us have been through recessions, probably a few of them, 2008, 2020, times in the market where we see our portfolios crumble and it hurts us and we don't know what to do. We start to panic. We kind of derail the plan. And I want to give you some tools today and some process and mind frame on heading into 2023 if we see a recession. There's a lot of talk about a recession. Whether it happens or not, nobody has a crystal ball. But you can prepare for a recession or a non-recession in a very diligent way that doesn't take a whole lot on your end. So let's break that down. A few of the facts and the headliners today. One thing is Ray Dalio. He talks about leveraging and deleveraging markets. And we're definitely in a deleveraging market. So we're holding our money tight. Savings is at an all-time low still with inflation so high. Everything costs so much. If we look back at 2022, over 250,000 Americans, 250,000 plus Americans that took out a mortgage in 2022 are already underwater. That's phenomenal. What's going to happen with the real estate market in Canada, US, and abroad? What's going to happen with the stock market? There's a lot of uncertainty as we head into 2023, and rightfully so. Whether you're 20 years old watching this video or 65 and ready to retire, this impacts all of us. So how do we prepare best for it? I like to start with history. What's happened in the past? What have the market corrections done in the past? How long has it taken to come back? Now, obviously, past performance is an indicator of future performance. And when I sold mutual funds back in the day, that was pushed on us. Like, you can show past performance, but make sure you have the disclaimer that the future is no resemblance of what's happened in the past, of course. We all know that. No one has that crystal ball. But we can look at trends and what happens and how you felt emotionally, psychologically, going through those bumps. So in 2008, the TSX took about 2.5 years to recover from the high to trough to up. And if we look at the Dow Jones over that same period, it was about 3 years, which tells us that typically it takes 2.5 to 3 years. And if you go back, that's kind of the longest period of time that it took to rebound. Now, there's some anomalies in there, but typically it's 2.5 to 3 years or less to recover, which means that if you're in savings mode, you're just plowing ahead. My philosophy, I'm in savings mode right now. I invest money on a monthly basis, I dollar cost average in. I get money in my bank account, I invest it. I have a strategy with it, but I keep investing. I don't really worry about what the market's doing. I worry about the companies I'm investing in and the quality of those companies. And we hire a portfolio manager to do that for our family. But if the market's going up or down, I'm not too worried. Now, if they take a big dip, I might try and find more money to get in the market, but I'm not too worried. My goal is long-term. My retirement is long-term. For those of you watching this video that are closer to retirement, which is the majority of you that watch our videos, there's obviously concern there. Well, Adam, I'm retiring in a year from now, and I'm worried about the market hitting a recession, going down another 15, 20, 30%. What's going to happen? This is where I have to look back at past performance. If it takes 2.5 to 3 years to rebound, that means that you want to have 2.5 to 3 years of cash flow ready to go. Now, I typically say 1 to 2 years. If you're more on the conservative side, bump it to 3 years. The rest of it is longer term. And if you look at almost any graph, you can see that the market, it might bump down, but over time it grows. The market over time goes up. We're going to have bumps along the way, and we will continue to have bumps along the way. Just because you're retired doesn't mean you're not going to experience this. But the way to avoid it and to buffer it is to make sure you have the cash flow ready to go for your cash flow needs. Now, How does this work? Well, look at your portfolio. Does it generate any interest income? Any dividends? Do you have maturing bonds? What kind of cash flow does your investment naturally produce? Your RSP, TFSA, wherever you need to draw money from, how much cash flow does it produce? How much extra cash do you need on top of that cash flow? That's where the planning has to begin. So if you need an extra $20,000 a year for the next 3 years of extra cash, then put $60,000 aside. Maybe it's in a GIC that you can get access to every year. Maybe it's just in a high interest savings within that investment portfolio. Whatever it is, if you can put aside the next 2 to 3 years of cash flow, the rest of it can kind of weather the storm. It can go through that trough and it can come back high on the other side. Remember, you can never time the markets. We want to time the market. I would love to say, here's my crystal ball, here's how to time the market. But when do you get out? And more importantly, when do you get back in? I say it all the time with buying stocks. It's easy to go find a great company and buy their stock, but when's the best time to sell? That's the hardest part. And it's the same with trying to time the market. You can't time the market. So if you're in savings mode watching this video and you're saying, Adam, like I have a lot of years to retirement, but markets still concern me. A couple things here. Have a savings plan, have a goal in mind, and keep plowing ahead. Don't let the markets derail you from your savings plan. If the market drops, you're getting more for your money. If it keeps going up, perfect. The rest of your nest egg that you already invested is going up more with it. That's great. But have a plan, have a savings plan, and stick to that plan. Of course, you want to look at your risk tolerance, your investment criteria, all of that to make sure that it's aligned, but going forward within the plan. If you're closer to retirement, you want to look at your risk. How much risk are you willing to take? How much money do you like in the stock market? If your cash flow plan shows for the next 3 years you need $60,000 out of your portfolio and you have $600,000 of portfolio, you need 10% of your portfolio. That means that 90% of your portfolio is still going to continue to work for you. Now, if the recession does come, yes, it's going to drop down, but long term it will go up. How much, how quick, we don't know. We don't have the crystal ball, but history shows us that it will go up over time. So again, 10%, you need short term, put that in cash or cash-like product to generate that cash flow for you. The other 90%, let it go. Let it ride, let it work in the markets. Now, again, you have to match this to your risk tolerance, because if the market goes down 40% and that makes you panic and sell your investments and derail the plan, that could cripple your retirement. So as you build out your retirement plan, look at how long your investments are going to be there for. If it's, look, your RSP meltdown is over a 15-year period, meaning that you have that RSP account for the next 15 years, we're going to see more ups and downs in the market. How do you buffer that? How much are you comfortable? How much rate of return do you actually need to meet your retirement goals? Make sure you have a clear plan in place, understand your cash flow needs, and understand how much can work for you long term. So when it is kind of riding the waves a bit, you know that, hey, that money is long term and I can let it ride the waves because I know the wave is going to be higher later than it is today. So instead of trying to worry about time in the market, again, like Warren Buffett said, it's more time in the market, not timing of the market. And Warren Buffett said it perfectly. I can't stress that enough. A lot of us are trying to time the market, and the data after data after data shows that you cannot time the market. But what you can do is create a great plan, know what the plan needs for cash flow or maybe for the savings plan if you're not closer to retirement, and stay true to your plan. Don't derail your plan because of what's going on in the market. Again, we're going to see this again and again and again. If you don't have a clear plan in place, that's step one. Get a plan in place and then understand what the plan is so that that cash flow down the road is cash flow for down the road. You can let that work in the market, build up. Again, a lot of you in your portfolios, you need that 5 or 6% average rate of return. Now, we're not going to get 5 or 6% every year. We know that. It's not, the stock market doesn't run like this. It's not level 5% every year. It goes up and down. We need to average the 5% over a 3, 5, 10-year period. And to do that, you have to take a bit of risk probably. So understand how much risk you need to take in your portfolio to meet your retirement plan. Just ask anyone that tried to time the market in 2008 or 2020. Those people, a lot of them are still sitting in cash, not sure what to do, and they've missed 20% or more upside in the market. Again, time in the market, not timing of the market.